Hey, what's going on YouTube? And welcome back to Tech Conversations. I am your host Guillermo. It is June 2nd. Hope you're all having a great day today. As you can see, another green day in the market for me, up over $600 or about 0.6% today so far. Very interesting day. A lot of stocks up quite a lot. AMC up over 100%. Let me know in the comment section below if any of you guys are holding AMC right now. So anyways, very interesting day, but in today's video, I want to talk about what approach I took when I first started that helped me grow my account very quickly. And so before I get into that approach, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Let's talk about what approach I took when I first started, and even to today, I use this approach. This helped me grow my account very quickly with options. And so there's a concept that I first need to make sure you guys understand here. So I'm going to go to NEO first, and I'm going to go over to the options for NEO stock. And I'm just going to take a look at one of these options. So I'll just click on this one right here. And so the concept I want to quickly talk about is implied volatility, also known as IV. So this represents the expected volatility of a stock over the life of the option. Now, IV is directly influenced by the supply and demand of the underlying option and by the market's expectation of the share price's direction. So the higher IV is, the more investors are expecting a bigger price movement in the stock. Now, we don't know which direction it is. And so as those expectations rise, or as the demand for an option increases, implied volatility will also increase. And options with high IV will result in high priced option premiums. And that makes sense because the higher IV is, the more investors are expecting a price movement in the stock, which means the people who are buying or selling these options are taking on a bigger risk, which means with bigger risk comes bigger reward or bigger premiums. Now, the other thing I want to talk about quickly is Vega, which is under the Greeks here. So Vega is an option Greek. And this can determine an option's sensitivity to IV changes. So let me quickly talk about how this works. So this is connected very closely to implied volatility. Anytime IV goes up by 1%, the premium on this option will go up by whatever Vega is. So if IV increases by 1% right now, this will go up by 0.0124, and that would be the new premium of this option. Now, on the other hand, if IV drops by 1% right now, the premium here will go down by whatever Vega is. So if IV drops by 1%, the new premium would be 0.89 minus 0.0124. So that's how Vega is related to implied volatility. So overall, the higher the IV on an option is, the higher the premium on the contract will be. The lower it is, the lower the premium on the contract will be. And so now that we understand that, let's talk about how I use that to my advantage to grow my account quicker when I first started selling options. And even to today, I still use this approach here. So what I'm going to do is I'm going to go to this website here. This is Market Chameleon. There's a lot of websites just like this one, but I'll use this one for this video. So I'm in the option implied volatility rankings report. This displays stocks with elevated, moderate, and subdued IV for the current trading day. So what I'm first going to do is I'm going to go click here and I'm going to do show 100 entries. And then I'm going to sort this by current IV 30. So this is the estimated implied volatility of theoretical 30-day options for this stock on the left here. So I'm going to click on it and then I'm going to click on it again. So this will start off by showing me stocks with the highest implied volatility all the way down to the lowest. So the highest right now is AMC. AMC very volatile right now. And so what we want to do is we want to find stocks in here. Now we're not just going to choose any stock here. What you want to do is you want to scroll through the list here, find a stock or a company that you were already looking to buy, a company that you're very bullish on in the future that you think has pretty big growth coming up. So let's say I'm scrolling down through this list and let's say I find, for example, Upstart Holdings here, ticker symbol UPST. So let's say I've been looking at this company for a while. I'm actually already thinking of buying it, and I think it's bullish. I'm bullish on it. I think it has a ton of growth in the future, and I think the price of the stock will go up. So this would be a great stock to use here then. So what I'm going to do then, I'm going to go back to Robinhood here. And this is just an example. So don't actually do it with Upstart here. This is just an example here. So again, let's pretend I'm bullish on this stock. I'm already looking to buy this stock. Let's say I wanted to buy, for example, 100 shares, right? So instead of buying 100 shares of Upstart right now, here's what we can do. We can try to buy Upstart cheaper. How can we do that? We can do that by selling puts, right? Remember, when you sell a put, the way this works is, let's say, for example, if I wanted to sell this put here, I'm going to have to put up some collateral. The amount of collateral will be the strike price times 100. So I'd have to put up $14,000 in collateral to sell this put. And the way that would work is that if on the expiration date here, June 18th, if Upstart was under $140 a share, then I'm going to be forced to buy 100 shares of Upstart at $140. And that should be okay because you've already determined that this is a company you want to buy, you want to hold long term, you're bullish on. So there should be no problem there if that does happen. And on the other hand, remember, for selling options, you receive a premium, right? We're receiving a premium for selling this put. How much? We're receiving $1,820 here. And guess what? This is a very, very high premium. Why? Because implied volatility is very high, right? That's what we first started talking about. IV is very high on this option and on all of these options. So then premiums are also going to be very, very high. And in fact, by selling this put, you're basically putting up $14,000 to make almost $2,000 in about 2 weeks. So we quickly take a look here, $1,825 for a $14,000 investment would be about a 13% return in about 2 weeks. The average investor gets about a 12% return in 1 year. Here you're getting 13% return in about 2 weeks by selling this put option, right, on a stock you were already wanting to buy. Now, as you can see, that's going to give you some pretty big returns. And if on June 18th, Upstart is above $140, then this expires worthless. You just made a 13% return. If it is below 140, you get to buy 100 shares at 140. But again, you were already wanting to buy this stock anyways, so that shouldn't be a huge concern. But again, you should only be doing this with companies that you're already looking to buy, you're bullish on, you think have huge growth in the future. But we're taking advantage of the fact that the premiums are very inflated and they're very high because implied volatility is very high here. And we talked about how that affects the price of the options here. Now, a couple of important things then to consider here. If you find options that have very high premiums due to high implied volatility, understand that there is a reason for this. So you should always look at the news. It could be due to earnings announcements coming up. Could be due to merger or acquisition rumors, product approvals, news events, things of that nature. So you should first do your research. Try to figure out why is IV very high on these options. Once you figure that out, try to determine whether or not this is an event that could cause the stock to change a lot in price. If it's not something that should be too concerning, then there shouldn't be a huge problem with you selling options on the stock. And remember, when you sell a put or sell a call, you choose what strike you're comfortable buying or selling your options at, right? All of these are going to have some pretty high inflated premiums here. Now, the reason for Upstart being, or the IV on Upstart being very high could also be due to the fact that this stock has gone up a ton in the last month. We take a look here on May 13th, it was at $81. Now on May 27th, it's $170. Now it's down to $150. So it could be investors believing that Upstart is due for a pullback, for example, right? But either way, as you can see, if you're already looking to buy Upstart, why not sell a put on it and take advantage of these very, very high premiums. Now, so to sum it up, when you find options with high implied volatility, right, you should consider selling strategies. So a popular phrase you may have heard of is buy undervalued options, sell overvalued options. So when IV is high, you should sell options. When IV is very low, you should buy options. So when your options have low IV, consider buying strategies. For selling strategies, we have covered calls, selling cash secured puts, which is the example I showed you, credit spreads, things of that nature. So this is the strategy, the approach that I first took when I started that helped me grow my account very quickly. But again, I was only doing this on companies that I was already looking to buy, companies I was looking to hold for the long term. And of course, doing my research on why IV was relatively high and making sure that, I was willing to take on that risk with that. So anyways, if you have any questions, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.